It's a story we see play out time and time again. A big, well-known company files for bankruptcy, its stock price craters, and then something really weird happens. People start buying it. So today, we're going to break down exactly why this happens and why it's probably one of the riskiest moves you can make in the market.
And that's the big question, isn't it? It just seems to go against all logic. Why on earth would you buy shares in a company that just told the world it can't pay its bills? Well, let's dive in and unpack this puzzle.
You can almost set your watch to it. A major company announces a Chapter 11 filing, and boom, you see this frenzy of trading activity. The stock is trading for just pennies, and suddenly tons of hopeful investors are scooping it up. And while it might seem totally baffling, there is a kind of logic behind it, a logic built almost entirely on hope and pure speculation. And this quote from an investor on Reddit, it just hits the nail on the head. That's the mindset right there. It's all about the lotto ticket, the dream of buying in at rock bottom and riding the wave of some miraculous turnaround or buyout. But how realistic is that dream, really? To figure that out, we've got to look at the arguments people make. So, what's going through the minds of people who are buying these stocks? Let's get into what you might call the speculator's bull case. You really have to understand this point of view to see the full picture. Okay, so take a look at these points. They all sound kind of plausible on the surface, right? The stock's cheap, so the risk is low. Hey, it could be the next huge turnaround story. Or maybe there's a surprise buyout coming. But here's the thing. Every single one of these points, especially the last one, is based on a fundamental misunderstanding of what Chapter 11 bankruptcy is actually for. And that right there brings us to the absolute core of this whole thing. See, Chapter 11 bankruptcy is a second chance. But we have to be crystal clear about who that second chance is for. It's for the company, the business, the employees, the brand. It is not for the common stock. So what exactly is Chapter 11? Well, the best way to think about it is like hitting a giant pause button. It gives the company legal protection from the people it owes money to. This gives them some breathing room to reorganize their finances, streamline operations, and hopefully emerge as a healthier business. Now, it is super important that we don't mix this up with Chapter 7 bankruptcy. Chapter 7 is the end of the road. It's liquidation. The doors are closed, everything gets sold off, and the business is gone. Chapter 11 is about survival and reorganization, and that's exactly why it creates this glimmer of hope for investors. But, and this is the key, the survival of the company does not mean the survival of its stock. Okay, this next part, this is probably the single most important concept you need to understand when it comes to bankruptcy. It's called the creditor pecking order. When a company reorganizes, there is a strict, legally required lineup of who gets paid back first. Yeah, there's no wiggle room on this one. The whole process is governed by something called the absolute priority doctrine, and the name really says it all. There is an absolute, unchangeable order of who gets paid, and you are not allowed to skip the line. And here it is, the pecking order. Right at the very top of the list, you have secured creditors. Think big banks who lent the company money that's backed by actual assets, like buildings or equipment. After they get paid in full, you move on to the unsecured creditors, your suppliers, your bondholders. Then, if there's anything left, preferred stockholders get a turn. And way, way down at the bottom of the list, who do we find? Yep, common stockholder. Let me just say that again, because this is everything. As a common shareholder, the owner of a regular share of stock, you are dead last. Every single group above you has to be paid back every penny they are owed before you are entitled to anything. So, in the real world, how often does any money actually make it all the way down to the common shareholders? Well, the hard truth is, in the vast, vast majority of cases, we're talking about 99% of the time, the money simply runs out long before it ever gets to the bottom of the list. So, if you're last in line and there's almost never any money left over, what actually happens to the common stock shares that you might be holding? The answer is unfortunately very simple. Here it is, the one word you really need to know: canceled. As in wiped out, erased, gone. What usually happens is that the creditors, the banks and bondholders, agree to forgive some of the company's debt in exchange for ownership in the new, reorganized company. That ownership comes in the form of brand new shares, which makes the old shares completely worthless. And you know what? There's actually a bright red flag that the market gives you to warn you about this. When a bankrupt company gets kicked off a major exchange like the NYSE or NASDAQ, a letter Q gets tacked onto the end of its stock ticker.
That Q is a universal signpost that says, warning, this company is in bankruptcy. Okay, but wait a second. I can hear you asking, what if the company makes a huge comeback? If it emerges from bankruptcy stronger than ever, won't my old shares be worth something again? This right here is the final, most dangerous hope that fuels the lotto ticket buying. And I wish I had better news, but the answer is almost always a hard no. See, the company that comes out of bankruptcy is essentially a new entity with a completely new financial structure. It issues brand new stock, often with a totally different ticker symbol. Those are the shares that have value. Your old shares, the ones with the Q, are just relics of the old bankrupt company. They don't magically convert into the new valuable one. All right, let's pull all of this together. What is the big takeaway here for you as an investor trying to navigate this tricky situation? Let's just run through the checklist one more time. Number 1, Chapter 11 is there to save the business, not your common stock. 2, as a common shareholder, you are at the very back of the line to get paid, period. 3, because of that, the odds are overwhelmingly high that your shares will be canceled and become worthless. 4, that little Q at the end of a stock ticker is a major red flag. And 5, and this is the big one, even if the company makes a fantastic comeback, it almost never means your old shares will regain any value. So, does this mean it's absolutely impossible for common shareholders to get something back? No, not impossible, but it is incredibly, vanishingly rare. These are the 1 in a million exceptions that just prove the rule. At the end of the day, banking on that outcome isn't really investing. It's gambling on a long shot, and the stock market's history is paved with the worthless, canceled shares of people who made that bet.
This is not financial advice.